Alright folks, welcome back. This is going to be a little discussion on secrets to volume and price delivery, and it provides me an x-ray perspective to future price swings. Alright, I'm going to talk a little bit about interbank order flow and price delivery, but the focus of this lesson is the contrast between retail support and resistance, trend following, that type of thing that everyone unfortunately gets indoctrinated in this industry through books, educators, and courses and such. And I kind of want to open your eyes to something else that is more pure than those ideas. Okay, it's going to challenge a little bit of your thinking and your treasured ideas, and I'm going into this as a friend. Okay, I'm trying to just open your eyes to something that is existing in price that you may not be aware of. And you'll see there's a strong contrast between what I'm showing you here versus other ideas and theories that are permeating in the industry. I'm going to talk a little bit how I track interbank smart money. I'm going to show you an example of a market maker sell model, and I prompted you all in the community tab to study a fractal and price action. That was a 5-minute chart, and we'll break that down into greater detail, but I'm going to show you some things today in this discussion that are highly precise. Now, when I say these things and I put it in video, many times the cynics will say, well, it's all hindsight. And I'm going to remind all of my students, okay, if I am not telling the truth, if everything I'm saying in this video is not what I outlined before the fact, you have my permission to thumbs down this video, all of you, okay? And that will be a loud, resounding evidence that what I'm saying is untrue, all right? So there will be a lot left out of the discussion, because I'm really not trying to teach mentorship, but I'm going to pull the veil back a little bit today and show you some of the things that my private group sees and we outlined in advance. Okay, so there's price swings that occur every single quarter. And what I mean by that, every 3 to 4 months, there's a particular price swing that will open up one direction or another. And my focus as an educator and as a mentor is to teach my students how to forecast those price moves. So that in essence is what mentorship is. Okay, just because you may have a friend that gave you a video or two or more of my mentorship teachings, that's not the same as I did ICT's mentorship, because my mentorship is ongoing and it's nowhere near complete. It's nowhere near 100% taught on any of the concepts. They're all just introduced. So it's a language we all use now. I have created a language so my students can understand when I'm pointing to certain things in price action that you can't find somewhere else in a retail book. And as you'll see today, I'm going to make public, okay, I mean, by making it available through my YouTube channel. Otherwise, it was in my mentorship and only taught back in 1996. If you were a one-on-one student with me, that cost you $20,000, not just to learn just one concept, but how to interpret future price moves and how to engage in those price moves. Well, over time, since 1996, I have refined a lot of things about how price action works with my trading and how I engage price. So I look for specific things in price that are highly specific and precision oriented, so that those buzzwords get used a lot now, you know, like smart money and precision and sniper this and stuff. These are all things that I've used over the last 20 some years, and I just want to get to the heart of the teachings and try not to use all these themes and such. So I just want to be me, okay? And hopefully this lesson, this conversation, if you will broaden your understanding, okay, and also open your mind to the possibility that even if you are a profitable trader right now, and I'm sure there's lots of you in my audience, there are things that are occurring in price action that you probably aren't aware of. And I'm going to try to show you some of them today. And I promise it's unrivaled in precision. So let's go over to the charts and I'll outline what I was hinting at on my community tab. Okay, so we're looking at the dollar index, and right away you should know now that that 5-minute fractal is the dollar index 5-minute chart from the 31st of August 2020. Now, before we even get into that discussion, I want to add some more value to this video, because I was going to just talk about how that 5-minute fractal is a market maker sell model. But as I started thinking about it earlier today, I was like, you know what, I'm going to teach a little bit more and provide a little bit more value and show you the contrast to what is in my free tutorials versus how I teach in my mentorship. Now, right away, the guys in here and gals that are turned off immediately when there's a sales pitch vibe going, nothing forces you to buy my mentorship. Like, there's only going to be January enrollment coming up. If you don't want to join, that's fine. But I'm still going to give you this lesson, and it just costs you the time to sit in front of the video. So, again, I'm not twisting anyone's arm. I'm not promising you and pulling the rug out from underneath you the last minute. I'm just sharing something that I think that would at least pique your curiosity. Okay? And before I get into it, as a reminder, my students that are in my mentorship, if I am embellishing, if I'm saying that this is what we did and I really didn't call these moves, then you are 100% invited to thumbs down this video, because I keep the comments closed. I'm not going to babysit the comment section of my YouTube video, so I'm not going to do it. There's so many people out there hating because they can't keep up. They want to just try to discredit me as much as they can, and I've made blanket statements before, and I put $100,000 out now. It's a bounty. If you can find everything I'm teaching prior to 1996 in writing or in video anywhere, you get $100,000, and I'll do a live stream giving it to you. I'll go wherever you are and give it to you. So I'm absolutely comfortable knowing that no one has this information but me. Now, that sounds ridiculous. I know it sounds absolutely ridiculous, but I can say that because now, after 27 years, no one has ever come close to what I'm revealing. It doesn't exist. The reason why, I was approached by two gentlemen that aren't traders, but they opened my eyes to how price is delivered, and it's 100% diametrically opposed to what we as traders are taught to trust, to believe. Okay? And we're told to believe in supply and demand, support and resistance, higher highs, higher lows, all those things. And they give us these tools, but they're really hindrances and blinders, but we call them indicators, indicating where you're going to think like a retail trader. Now, think about that for a moment. When you apply an indicator to your chart, you, in your belief system, regardless of whatever discipline of trade theology you use, the tools that you're applying to your chart, you believe that they are giving you some foresight, some prognostication. I believe that stuff too. Okay, when I sat down in 1992, I believed wholeheartedly that RSI was the secret recipe to success and divergence on that indicator, plotted on a 14 period. And then it didn't work. So then I went to a 20 period stochastics, and then it failed. Then I went to a 10 period stochastics, because if it was faster in reaction, that's the real secret. I was clueless, okay? So I'm going to tell you that if you just investigate some of these ideas, okay, spend some time in your charts, and I think you'll be pleasantly surprised. Now, you're not going to hit it like I'm outlining here, but I'm on record back in June, and for my mentorship students, you can go back to June 10th, 2020. That video, we outline a very specific level that I'm going to talk about here. And then all subsequent videos after that and commentaries was leading to where we traded to today in dollar. Okay, and if I'm not telling you the truth, you're going to see tens of thousands of thumbs down on this video. Okay, and that will be your indication. You don't need to have a person go on my commentary section. It'll be evident in the thumbs down rating on this video. Now, I always get like a dozen or so thumbs down because guys just like to do it. But in this video, if you see thousands and thousands of thumbs down, that means that my mentorship students that can see this video, because it's public too, they're telling you that what I'm saying in this video is absolutely false and that I'm lying and I'm a fraud. That's how you determine that, okay? Now, I don't have 10,000 or so. I don't have thousands of YouTube channels, okay? I don't. And I certainly don't have the time to sit down and hurry up and create them and then thumbs down the button. Okay, so obviously you can see where I'm going with this. I'm being facetious here. I'm saying this without having to go actually into the video, because I was going to do that. I was going to go through the video, but where I start talking about it, I'm also talking about other things that I don't really want made public. Okay, because it's meant for the students in my mentorship. But even with those things withheld, you're going to get something from this lesson. So I want you to, if you're doing other things and you're distracted, come back to this video later when you can devote more of your attention to it and not be distracted. Otherwise, you're really not going to get the point I'm trying to come across with. All right, so as I mentioned, every 3 to 4 months, there's a quarterly shift. That's how I teach it in the markets. Now, it's not just Forex, and what I'm going to cover today and discuss really isn't limited to Forex either. It's the markets in general. So the markets will always seek yield. They'll always be moving up and down, gyrating. But if you break down the market, any market you're looking at, and you look at how the price swings occur, every 3 to 4 months, there's a significant price swing. It may swing higher or it may swing lower. My job as a mentor is to point in the direction that these moves are going to occur and where they're likely to go to. Now, understand this. This is not a signal service. Okay, I give all the tools on how to get in and engage. I specifically point to levels that should react with the tools, but I do not sit down and say, buy here, put your stop here, and take your target off here. I don't do that. I'm not licensed to do that. And if you have aspirations to join my mentorship, I want you to understand that that is exactly what we do. I point, I outline where the market's going to go, and then you use the tools that I taught in core content and ongoing commentaries that I do on Wednesday and on Friday. Those are the procedures that my students follow. Now, most people don't have the discipline to do that because they want a recipe handed to them. ABC, 1, 2, 3, do this all the time, and this is how it's going to work. That doesn't work in the markets because there's so many different variables. You have to be able to decipher what price is likely to do. And the first thing you start with is a bias. Where is it likely to go, higher or lower? I'm going to talk a little bit about that today. And I'm also going to talk about quarterly shifts where we have a little bit more magnitude of a price move. Okay, because you've seen, if you've been through my YouTube video or video library on this channel, I have various videos where you can see me entering, exiting, managing live trades, reversing, buying long, going short the same day, back and forth. Everything that you're seeing me do in those 1-minute charts is very similar to what I'm showing you here. It just takes a whole lot more time for these to pan out. And I don't have a lot of patience. I'm easily distracted, and I'm not as patient as I may come across as a mentor, which is the reason why I specialize in day trading and short-term trading. You know, a 3-day, 4-day hold for me is sometimes agonizing because I don't want to be overnight holding a lot of risk. I understand the daily range enough that I can get in and work that daily range and be out and sleep well and not worry about if it's going to reverse and run hard against me. Now, you might be thinking, oh, well, if you're so good, why are you worried about that? Well, because when I trade, I'm not trading with 10 cents per pip. I'm not trading with $1 per pip or $2 per pip, even though I give those examples to show you in real terms how you can relate to it. Because if I go in here and I'm trading with $500 or $1,000 per pip, who can relate to that, especially if you're a new student? It looks like I'm showing off. You're probably not going to believe me anyway. So to keep things very germane and easy to work with in conversation, I use examples now that are very low leverage. Also, trying not to entice people to try to run as fast as they can to ridiculous leverage. So when we look at these examples of price movement every 3 to 4 months, that is a large magnitude price move. That's about as long as my vision, okay, or perception on price action limits me. Like I don't see like 5 years ahead. I don't see a whole year ahead. I'm usually about 2 to 3 months visibility, and it's not 100%, but I have a really good track record, and everyone that is in my mentorship, they see it unfold every single week. I'm calling specific things, and it's a different kind of ICT. On YouTube and on social media, I have carried on a lot, okay, because it's been like entertainment. I'm trying to move away from that and try to be as beneficial to everyone versus the folks that just get the inside jokes that I'm always making. So anyway, I want you to look at the June highs, okay, in the dollar, and that's right in here, okay? And I want you to think, what ideas would lend well to this creating a selling opportunity in retail thought? Okay, I want you to stop the video and give it some consideration, and then when you've exhausted all possible ways of determining that that is a shorting opportunity, then press play, and I'll go into annotations and discussion further on. You didn't pause the video, did you? See, you're cheating yourself, but oh well. All right, so now obviously we know that support and resistance, all those ideas. The only thing that I would believe off the top of my head folks would look at would be a bear flag. Okay, you see this long decline and then consolidation, but everything is going slightly higher. This is your flag portion, and then when it breaks down, it'll usually repeat the same leg in terms of price range from this low up to this high once it breaks this, and then basically we did about that. Okay, now I don't know about you, but I've traded a lot of bear flags and bull flags over the last 27 years, and I can tell you I've lost more trading those things than I've won. What? Yeah. But here's the thing, I can go back and write books and make courses about the times where it worked. And if you bought the course or read the book, you would walk away thinking that that was the secret recipe to trading. Continuation patterns, bull flags, that's all you need. Listen, if there's a proper context, then that stuff will work. I've mentioned in other videos where if you understand the logic of how price is delivered, okay, what do I mean by that? The market's going to go where it's going to go regardless of what you believe, what your system or theology says about price. It's going to go where it's going to go because it's predetermined. It's absolutely controlled. It's rigged. The whole system's rigged, period. Now, you may have people from Goldman Sachs. You may have people from JP Morgan, Merrill Lynch, XYZ, trading prop firm, whatever. They're all going to tell you that largely that's not true when they themselves are indoctrinated in the school of thought where they work. They're told this is what happens, this is what you do. It's probability, it's statistical, it's this, it's that. No, it's rigged. It's absolutely rigged. These markets are going to go where it's going to go because it's programmed to do so. Okay, when I was going through school, I wanted to be a systems analyst. I had to learn programming to understand how to communicate to the programmers how a system should be programmed by my outline from my documentation stage, all the things that I needed the system or program to do whether it be a payroll system for a company's employment payment, whatever it is that I was looking to be hired to do, I had to have a way of breaking that down into a manner so I can speak to the programmers and say, hey, okay, this is what I need you to do. I need you to do this, and it has to answer this problem, and this problem. And then when they present it to me, then I have to resolve whether or not this is going to fit the client's expectations. That's what I was going to school for. That's what I went through my education in computer science, specializing in information systems and mathematics. So I am highly technical coming from that field. So when I looked at price, I knew that if everything I was doing was based on these books and these indicators, and it wasn't working, the money that was leaving my account was going into someone else's account. So what are they doing that I'm not doing? And when I started reverse engineering everything that leads to retail theology, I started seeing things in price. And when I met two gentlemen in the early 90s, they opened my eyes to how price is delivered. And it's basically a self-fulfilling prophecy. We look at these wiggles and waggles on our charts, and we attribute that thing that we're looking at as, oh, it's one of our secret patterns. It's something harmonic. It's an order block. It's a supply and demand zone. It's a support resistance level. You get what I'm saying. Everyone has these little things that they like to classify as the reasons why the market's going to do what it's going to do, or why it most likely in the past has done it, because hindsight usually is what everyone uses. And I get this. When I talk about what I'm going to show you here, it's going to sound all hindsight, but I'm on record, okay? And a lot of you plan on joining in January, and you are absolutely welcome to make a YouTube video in response to this video and say, ICT, you are a liar. You did not say that the market was a bearish environment where it was going to go down to where we're seeing trade to today, okay? So if I can just capture your attention, because I probably already bored some of you. I'm talking too much, I know. But I want you to appreciate what I'm showing you today. Because if I just sit down and say this, and it's a 7-minute video, you're going to be like, okay, big deal. That didn't teach me anything. But I want you to contrast what you as a developing student or trader are dealing with internally, because you can probably give me a dozen times where your things are working for you. But if you're honest, there's more times that it isn't working for you. And you attribute that as, well, as long as I'm doing a 3-to-1, 4-to-1, 5-to-1, 10-to-1 R multiple on my setups, it doesn't matter how accurate. And I guess in a way, you're right in that sense, but why would you want to trade in those environments and still accept low hit rates? See, I don't like low hit rates. I want to know that I am in the know. That means I'm engaging price when it's so likely to go where I want it to go, the direction I want it to see it trade in, and reach a level that I've already outlined. Now, that sounds like the obvious. Everyone's doing that. But everyone isn't doing this level of precision that I'm going to show you. So with that said, apart from bear flag, there's really nothing in here, because if you say, okay, well, oh, it's this level right here. Okay, well, why this level and not that one? And why not this level? Or this one? Why did it go here and turn around and go lower? Why did it do that? June 10th of 2020, I outlined, and I didn't just teach it June 10th of 2020. This is actually one of the concepts that I teach in my mentorship group. And it's called a volume imbalance. Ooh, sounds cool, doesn't it? Yeah, it's not in your books either. But what this is, I'm going to zoom in. All right, let me scrunch it up a little bit so you can see what I'm referring to. All right. Right in here, you see this candle? Right there. And then the next candle right there. If you were to look at the difference between this candle's close Okay, that closing price is 97.68, and this candle's open at 97.57. Okay, that is what I teach is a volume imbalance. Now, what does that mean? What it is there's a segment in price that when the algorithm delivers sell side, because I'm referring to this as a sell side volume imbalance. So it's basically saying we're below it and it should come back up into it. All right. Now, when we look at a gap in price, usually there is no wick, no body crossover. There's a segment in price action where there's simply no trading, none. Everyone that's familiar with technical analysis is familiar generally with a common gap. This, you can see the candle's low crosses over and into the body of this candle. When this candle opens, it opens here. So there's a difference between it's open on this and close here. There's a small little wick above this candle. I guess if I zoom in a little bit more. There you go. So we have this candle's closed, this candle's open. That little segment of price action right in there. These things have existed on your price charts forever. And no one has ever wrote about it, never made courses about it, never drew anyone's attention to it at all until I did. Now, what do you do with it? You anticipate price trading back up into that. Why? Why should price trade back up into it? Well, price is dropping here, and it got a little ahead of itself in here. So even though we went down on this candle's low, it left an imbalance, a volume imbalance. Now in Forex, we don't have a real clear depiction of volume. We have an absence of volume. So we have to use other tools. So that's why when I see folks trying to trade with the volume profile with Forex, to me, it's kind of like a partial picture. You're looking through binoculars with one eye closed. You're seeing things and you're getting magnification, but you're not really getting a clear depiction of what price is likely to do. And you certainly aren't seeing all the volume. So what do? You use the bodies of the candles. Now, there's a lot of school of thought for specific concepts in my teachings where we use a wick, we use a tail, and we use the bodies. There are procedures and protocols to use for each individual concept, and that's not going to be taught here. And you don't need that. What I'm showing you here is very specific about price, where there's a small little gap between the bodies, even though there are wicks and tails crossing between the two candles. Okay? So, price on June 10th, I drew everyone's attention to it in my mentorship right there to look at that area and anticipate price trading up into it. You can see we traded up into it here, and then price rolled over. You can see the same thing occurring right here. See, here's the candle's close, and here's the candle's open. That small little segment of price action, we trade up into it here. And again, I told my mentorship, if it trades to this level, we should anticipate rolling over. So here we're bearish, here we're bearish. Okay, long story short, we were anticipating lower prices in dollar. Why would you expect lower prices in dollar? Well, all the things that's been going on with the illness that's been going around the world, and I'm going to say just that and not say any more because YouTube will flag me if I say anything more. And the likelihood of the dollar going lower was more likely to occur than the appreciation for it if it broke below this range. And we saw it break down. And admittedly, while price was in here, just so full disclosure, when price was back and forth in here, I was telling my group that we are sitting on our hands waiting for a clear discernible move that's going to go higher or lower. And at the time, I didn't really care which direction. But when we got to in this area here, we're bearish. And we've been bearish on the dollar. I gave a clear indication as to where I believe the dollar would go. Okay, and I'm going to put the levels up in a moment, but I want you to think about how price traded to this volume imbalance right there and traded all the way down to today's low. See that? Now, this movement in dollar is many, many pips in foreign currencies, especially in like cable, like British pound versus US dollar. So if we see a 400 or 500 pip decline in the dollar, it can many times go way beyond that in cable, because cable tends to over exaggerate everything, which is why I love that pair. It has a lot of volatility. It's predictable volatility versus like the Swissy. Swissy can be finicky. It can still unload where I think it's going to go, but many times it'll come back and take my stop if I start moving it. And it's just has a lot of volatility, the Swiss franc versus US dollar. And in the 90s, I used to trade a lot of it as a futures contract. But when I segued into just pure Forex in 2006 and left futures, then I got burned a lot with Swissy. And when it was depegged from the euro, I was done. I was done before we got into that. But anyway, the difference between the dollar movement on quarterly shifts, if we have a large several hundred pip move in dollar, that is very, very huge potential in foreign currency, because the dollar it's kind of stunted in its movement. So if there's a big move in dollar, there's huge moves happening in foreign currency, and even larger moves in the crosses, because they're even more exaggerated. And what do I mean by that? Like euro yen, pound yen, those types of crosses, or Aussie yen, euro, Aussie, those crosses that I don't personally trade because I don't get the tax treatment in the US by trading them. So yes, there's a lot of moves that occur that I know I could be a participant of, but I don't care, because I can make 10 pips a day and do everything I would ever need to do in my lifetime. It's what you do with the pips you earn, not how many pips you earn. It's not about how many. That's not how this game is won. It's how you manage the risk and how you leverage within reason the result that you can measure as a constant result in return on the engagement you're placing in price. That's the reality of trading. So if you are thinking that you have to get these big moves like this, that's not what I'm trying to communicate here. I'm saying that even though this is not my cup of tea for trading, like getting short dollar here, because I don't really trade dollar, I use it as a barometer. So I'm going long foreign currency in this instance. Okay. We were long on euro. We were long on cable all throughout this movement. So I want you to see where I drew everyone's attention to over the course of this decline in the dollar. Okay. This low here and this low here are relatively equal. See that? Now I'm going to zoom in on that little piece of price action right there. Okay, so you have this low and this low. More specifically, it's this candle's high to this candle's low, or what I teach is a fair value gap. Now, fair value gap is something that's mine as well, and you don't see that in books. A lot of people have been exposed to it, now are trying to make videos about it on YouTube, and they're not right. You have no idea what you're doing, so when you do that, you're actually doing a disservice to your viewers, because I haven't taught everything about fair value gap, and every little segment in price action like this isn't a fair value gap in the sense that it's going to be traded too. Eventually, I guess in a long enough time, everything would be traded too, but the way I see these people on YouTube trying to use it, build a name for themselves, it's pathetic. But nonetheless, This area in here is what I was drawing my students' attention to. Why is that important? Well, we have a period of equal lows. The fair value gap is imbalanced. In other words, this displacement higher, the algorithm moved too fast and did not allow time for any real selling to occur between this candle's high and this candle's low. So all of this at some point between this candle's low and this candle's high should be rebalanced in the future. Enter those levels. Now you have liquidity. Now you have sell side liquidity resting below. What's sell side liquidity? Sell stops. The liquidity that's framed on the basis of if the price goes lower, it's the sellers that are being attacked. Okay, so that's why I label all my annotations below lows. It's sell side liquidity, and I'm using that with a market efficiency paradigm. In other words, when I look at price, I'm looking at these sell side liquidity pools as a reason for price to go down there, and that's where smart money will be looking to buy from. Why would they want to be buying? Because they're short, and to get out of a short, you have to buy it back. So sell side liquidity resting below here to a point of rebalance at this candle's high at 91.92. Now 91.92, isn't that just below the 92 big figure? Yes. When markets sweep below a big figure or above a big figure, they will do it in specific grades: 5, 10, 15, 20, 25, 30, and can spike through as much as 40 pips. If we were looking at the 92 big figure, we could reasonably expect it to trade 10, 15, 20 pips below it, which would give us what low in potential range. 91.70 if it's 30 pips below it, 91.75 if it's 25 pips below it, and 91.80 if it's 20 pips. It's usually what it usually does, around 20 pips below or 20 pips above. Certain characteristics with specific currencies like cable have more parameters to picking how many pips above and below it can go. And just like Swissy has its own, Canadian dollar has its own little signatures that how it works, big figures and mid-figure levels. I teach all that stuff, and I've hinted at a lot of things even in my free tutorials. So don't think if you just watched this video and your first time here and you found me just put this video, don't think that I'm teasing, dangling a carrot. There's a lot of lessons in this YouTube channel that if a diligent student sits down, takes copious notes, and really studies the things that I draw your attention to, you will never need to buy a signal service. You'll never need to buy a trading course if you just want to go in there and find a way of trading. My YouTube channel teaches that. But my mentorship level content is for the freaks that just want to know everything. Okay, and then know that they know. That's the difference. You can be profitable with the content that I give on this YouTube channel. Absolutely. Will you be a freak of nature? Probably not. And most of you really don't really care to be a freak of nature. But I know some of you young guys out there, you just want to be superhuman. But if you look at how price trades down into these levels. Now, obviously, I have these two vertical lines, which will make sense in a moment. But we spiked down through that 92 big figure, and today's low is, it's not right. Let's see. There it is, 91.75. Okay, 91.75. So it spiked through 25 pips below the 92 big figure. I was drawing everyone's attention here while this price was declining. We had this target here first. We managed and seen how price traded through that. We wanted to see a big displacement below that. We got it. Then the same thing. We want to see a big displacement below this low. We got it. Okay, so there's a volume imbalance here, calling that high, and this high is here. Volume imbalance there. Okay, so that's not support resistance. That is price delivery. It's the algorithm going back to points of reference that it needs to refer to cause the market to be efficiently delivered. Now, it sounds like a whole bunch of mumbo jumbo, I know, but it's the truth. The market, when it goes and reaching down here, right away, everybody's thinking, well, this is the old support, so it's going to trade down to there and it might bounce. I used to think like that, and you probably think like that too. Or we're probably thinking that if you were looking at the dollar. Or you're probably asking yourself, why didn't it do that? Or why didn't it bounce at that level there? Because the algorithm was going to reprice below this low and target this level down here. We knew about it for months. Now I'm telling you why we knew about it. So that way you can investigate it and see and study all the price action between here and how many trading opportunities were available. Some of you may be thinking, well, if you can call these moves, why don't you get short dollar, long foreign currency, and hold all these moves in every foreign currency and be a billionaire? I've already stated that I don't have the comfort of holding on to these positions because I have a very short-term personality. Like, I'm changing my mind a lot, like just like that. And I've made my mind up over a dozen different changes in what I wanted to talk about today. That's why I was delayed. Nothing really was delaying me. It's just, what did I want to talk about today? Did I want to go this far? Did I not want to go this far? And these are moves that already happened. So my students can't be upset about this. And plus, it's my content. I can do whatever I want to do with it. But you're not learning mentorship by me doing this. I'm just like I'm doing in the core content lessons. I'm providing you an example of a concept. Providing an example is not the same as me saying, okay, now we're expecting the price to go here, and then I go back in and I fill in all the gaps with why the details led me to that decision. And I'm 90-some% accurate in terms of where the market's going to go in a higher time frame. So that's me playing the scout, okay, or the spotter for you as a developing sniper. I said I wasn't going to use those themes, but it just fits right now for me to be able to justify what it is that I do as a teacher. I use my experience and the years I've been doing this, and I lend that to my students. So they're not trying to be bullish on dollar here. Their framework is outlining short opportunities on dollar, which would be the opposite in foreign currency, which would be long currencies. Okay, so with all that said, that's the framework. So we have this. I'll put this on the chart so you can see it. This is the volume imbalance. Okay, look at the bodies respecting it in here, and then we get one little spike that takes out these relative equal highs, and then it goes lower. The context was that volume imbalance targeting this low and then ultimately going down here. Scrunched up, so you can appreciate the full fractal. There you go. Okay, so I'm not looking at this low here or this low here. I'm looking at all the storyline in this price move higher. And where my eye goes is the imbalance or liquidity pools. There's only two decisions I need to make about my trade, because the bias is the easy thing. If I want to be a buyer or a seller, that's the easy stuff. And I know I probably just offended a lot of you. Well, that's the thing I'm struggling with, Michael. How could you say that? That's ignorant. You're not sensitive to my needs. Listen, I'm not laughing at you. I'm laughing at that's how I felt too. Okay, back in the 90s, I felt like that too. I was like, man, these people write these books, or I'm watching these VHS tapes, because that's what we were using back then, and then eventually CDs, and all this stuff. I'm like, they make references to things like I should know it, but they're not really teaching it. So I get it. Okay, I'm trying to do my best to communicate something that just isn't taught. And this is what I mentioned earlier in the video. Just because you may have someone share a video with you, okay, that's mentorship grade, and it's like, oh yeah, I have his month number 4 lessons, and it's this and it's that, so I have his mentorship. No, you don't. You have the same thing you all are watching right now, where I'm demonstrating something that I know like the back of my hand, but nobody else is able to use it all because I'm not done teaching it. It's 27 years of experience. You cannot condense that down into one video. You can't. No one can, because there's so many moving parts and so many things that leads to mastery. And that sounds arrogant, I know, but it's the truth. You're not going to find this with a one video solution. There's no one silver bullet solution in trading, especially with the things I teach. Now, you don't need every facet of my mentorship to find a niche where you're able to go in and engage. But what I mentioned earlier is I'm not worried about the bias, because if I understand at this point here to here, now I'm not going to sit here and count every single candle, but this is something I want you to do as a viewer. I want you to count the number of down days versus the up days in this fractal. Okay, a fractal is this segment of price action from here to today's low. All right, so from this candle's high all the way down to today's low, count how many down candles you have where the open is higher than the close, or I guess the easiest way to say it with the value behind it is every lower close day. In other words, in this case, every down close candle, to me, I represent that with a black candle, and every up close candle is green. From this high to this low, you can see the majority of the candles are down. So that means every single one of those days until we get to this level down here, if you're a day trader, you want to be going short. If your objective is to get 50 pips a week, okay, how hard would it be to get 10 pips in one day over the course of a week? Starting with that objective and then growing from there to maybe 15 pips a day and then 20 pips a day, and then learning to trust this big type of move and work within the weekly range and try to get a very premium price level. In other words, an elevated, expensive price level that shouldn't stay expensive for a long time until it eventually starts to gravitate towards this low down here and move to a discount. Okay, so bias is easy, but you have to have these types of narratives on the higher time frame, because if you do that, then yeah, you might get burned with one or two up close days that runs against you. But okay, how many up close candles are you getting in this grand scheme of things? That's the potential for losing if you try to trade every single day. But if you look to trade after a up close day, how many times are you met with hard selling the next day or the day after? There's a secret for you. Study that. So you have to have the logic and the context that the algorithm is going to be operating in, because it's going to reprice down here. Now, I know some of you are saying, but why should it go here? You're not saying that, Michael. Right. That's mentorship. But between this level here to here, that is the bookends, if you will, the dividers that frame that move. This volume imbalance to this fair value gap below old lows on the daily chart. It's all I'm going to cover for right now. But I promise you, if you look at every single 3 to 4 month price move in any market, similar signatures like this will jump off the chart. But you're not going to just watch this video and say, oh, I know how to do this. I'm going to go out there and start making YouTube videos and start a channel where I'm going to make all these moves. I see lots of people on TradingView, okay, trying to put my stuff on their charts. And if you press the little tab, it goes the other direction, screaming against them. They have their order blocks on there. They have their fair value gaps on there. And these are people that I've also warned, and I said, don't try to do this publicly, because you don't even know what you're doing. You don't know what you're doing. All of my students are still in development. They're growing in their understanding, but I'm walking them hand in hand every single week, telling them what direction this market's going to go and where they're going to go. Okay? It's not a signal service. I did not go in here and give them sell signals and setups for every single down day. I didn't do that. I keep pointing, training them to trust these types of moves. And if you operate in this context and you have a bias that's bearish, you have 80% of the battle already won. What do you do with the rest of it? Well, you can look at the opening price at midnight and try to trade short at that or above it, or wait for New York setups and wait for a bearish optimal trade entry, just like I taught on the YouTube channel. It's just that easy, folks. It doesn't seem like that's all that's required, but it's a discipline of waiting for these types of moves to unfold on a higher time frame and then engaging with that with the market efficiency paradigm. That means when I'm looking at the marketplace, I'm looking at how the interbank traders are going to be looking at this level here and looking to go short. When all of these ideas in here are going to frame harmonic patterns that are bullish, supply and demand areas. Oh, this is a demand zone. Everybody thinks it's an order block, and it starts to rally. You get excited. We're looking at how the interbank price delivery is provided for our charts to show it as it's developing. Everything that happens in the marketplace is absolutely controlled. It's programmed. It's predetermined. It's just a matter of how much time is it going to be required to unfold. That's the variable. That's the thing that throws every trader and me off. The algorithm can stay in a state of consolidation longer than you're going to be comfortable with. And that's the reason why, if you watch all my trade examples, I am never in a rush to move my stop, because I understand that facet about the algorithm. The algorithm is, I dubbed it as the interbank price delivery algorithm, IPDA. Okay, IPDEA. That is what causes these markets to go up and down. It's not buy and sell pressure. It's not supply and demand. It's not your patterns. It's not nothing harmonic. Okay, there's instances where you can look back and say, oh yeah, it looks like that. But I've already made this argument before. Try to use every theology that you understand in these big moves, and not all of them are going to agree. If it was true, if that's what these markets were working off of, all of them should agree. They don't. Harmonic won't line up with Elliott Wave. Elliott Wave won't line up with Dow Theory. Dow Theory won't line up with supply and demand. All these things, they're going to come in and out of favor. And no one's, over the course of history, ever sat down and said, well, how is it that the market knows which one to choose that it's going to follow today, or this week, or the next 3 months? What discipline of trading is the market using now? When it's neither the supply and demand, Elliott Wave, Dow, none of that stuff. It's not any of those things. It's what I have been teaching since 1996, that they are programmed and they're delivered with a premeditated idea of where it's going to go. And if you understand these signatures in price action, you can forecast with a great deal of precision where it's going to go. And then use other tools that I've made freely available on this YouTube channel and operate with a level of precision that is unmatched in any other trading discipline. Period. Done. Now, with that said, and with these levels here on the chart, I'm going to zoom in and now talk a little bit about what I hinted at on my community tab. So I got to zoom in here and get this chart to show what I wanted to focus in on. All right, and I'm going to ask you to work with me here and not pay so much attention to these daily dividers here, because it's only showing August 31st and the 1st of September. That's what's delineating. You'll see it when we drop down to a lower time frame. But what I want you to look at is this candle's low, okay, which is right there. Then we had this candle here drop down on and hit the first time, hit that high end of that fair value gap that I told you that we were looking for it to trade down into for a longer term trade. And then here on the 31st, we traded down. And before we went down, we went back up into this low. So this is what I teach as a immediate rebalance. Michael, you're giving away mentorship. No, I'm not, because I can talk about this and it's still going to be useless to the people that just simply watch the video and have not been mentored. Okay, it's like showing you an axe, okay, and saying, okay, look at this axe right here. I own this axe, and I own this axe, I own this axe, and I pick it up and I throw it at a tree and it sticks it the first time. What's the likelihood of someone going over and grabbing an axe out of the choices I lay in front of them, picking it up and throwing it, hitting it, and sticking it in a tree? Probably very low. And it's not because I'm trying to tease anyone. I'm just showing that I could literally put this stuff on YouTube, okay? And unless you're trained by me, it's not going to work for you. Like every other discipline in trading, you have to understand why the market's going to where it's going. That is a development. That's an understanding that comes with time. That is mentorship. You just can't watch videos okay, and say, I have it all now. It's the length of time that you work with under tutelage, saying, okay, this is what should work right now. This is where it should go. This is how it should develop. And this is how it should post on your chart. And having someone that can do it, namely me, that is being mentored. Okay, that's how you use the tools properly. You're coached along the way to focus in this environment, trying to focus only on this outcome. And then you force yourself to train with discipline and only working in that context. Over time, by doing that, everyone finds their own unique niche with this content. As weird as that sounds, it should be, I know what some of you are thinking, or probably a majority of you. If you go through my YouTube channel or if you go through my mentorship, everybody should have the same cookie cutter approach, training or trading concept or method or plan, and they all get the same results. And that's not true. It's not true, because all of us have a preconceived idea about what is successful, what makes you successful in trading. If you make this much money a week, if you make this much money a year, if you earn this many pips in a week. I don't think like that. And I probably don't have 3-4 dozen of my students that would even say, yeah, I agree with that thought process either. They all have a different way of interpreting it. And as weird and as unlikely as it sounds, it is true. You're going to be able to see how many setups exist in the marketplace with the things that I teach, and you can literally carve out your own way of doing it. I have people in my mentorship that when they sit down and they make it to charter level and they sit down and say, hey, this is what I'm doing. And I use this, and this. And I never touch this, and all the other stuff. And they are consistently able to find the next move, frame risk, and their targets are hitting. Now, that same individual cannot go back into my mentorship and say, Michael spelled this exact model out with this. All they did was they seen what time of day, what day of the week, what time of the year, what specific market they like to trade in, what characteristics and signatures that I taught conceptually and modularly, and they put them together that makes sense for their individual personality. That's how much opportunity these markets have. But you are all, just like I was in the 90s, are being distracted from the very truths that are in price because you're looking at all these other things. And you're so busy trying to defend it against people like me. That's what I've done for years. I've enjoyed, as mean as it may sound, I have enjoyed trolling other people with these ideas that this is why they think the market trades like this or that. And it's nowhere near like that. None of that stuff is real. It's not. Because if it was real, it would be so consistent, it would be 90+% accurate, like my stuff is. Now, I'm teaching here how prices really book. End of story. There's no fluff to it at all. Okay, the market's weak. It's going to draw to a discount. What's the discount? These two levels in here. Okay. Around these two levels, what's the lowest red line? 91.92. That's below 92 big figure. So 91.92 is essentially 8 pips below the big figure 92. I mentioned earlier, as I teach this too, whenever price trades through a figure, anticipate it not stopping directly at the whole number. Okay, there's nothing psychological about these levels. They are mislabeled by everyone by saying it's a psychological level. No, this is where large orders of commerce are grouped around. Okay, so when there's global commerce that come into the marketplace, they're just many times forced around these levels. So that is the real reasons why they're reacting as they are, because there's liquidity placed at or just above or below these levels because they're just predetermined orders. They know they have to buy a certain number of a currency or sell a certain number of currencies for a large corporation, like for instance Microsoft. Okay, if Microsoft wants to do business in Canadian dollars, okay, and they are going to be operating in Canada, they have to turn their dollars into Canadian dollars. And when those large orders come through and the banks have to do that transaction for Microsoft, they'll just spit it out around that level unless Microsoft comes in and says, look, we have to have it at this level or close to it. It's an oversimplification of the idea, but there's nothing really psychological about the whole numbers. Okay, it's around commerce. So let's segue into the 5-minute discussion and bring this, because I'm on a roll. Obviously you can hear me going, and maybe I'm going a little too fast, and maybe a lot of this going right over your head, but I haven't talked a lot recently, so I have a lot of pent up energy. So I want you to, again, remember this low here and how this candle traded up into that low. You can see that little blue line here, and this next little blue line that creates this candle's high. Okay, yesterday's high, the 31st of August. It'll be very clear as to what that is. But before I do it, before I drop down to lower time frames, I want you to think about this big down close candle. All right. If you're bearish, okay, if you're bearish, I'm going to give you a golden nugget right now. If you have a bias that is leading to you believing that the price is going to be going lower, okay, over the course of the next day or days or even weeks, if you have a big down close candle or a bearish candle, the opportunities that exist at the midpoint of that candle and to the low, that's your sweet spot. Okay, what do I mean by that? If the market's going lower, okay, many times you'll see how, like it does here and like it does on this candle here, where we have a down close candle. If we're bearish, the next candle here, it trades up into the previous day's candle, but working specifically at the 50% of the candle and to the low. So the next continuation is going to occur there. Over here, same thing, looking at the bodies. We have a down close candle. Next one here, we trade up into, and we even cross through into the volume imbalance right there. Does it completely close it in? No. Next candle here, it closes down. So we used 50% of the candle into the low. So the next sell scenario for the next trading day is here. It's going to occur within the range between the 50% or the low of that previous down close candle. So why is that important? Over here, and I teach this. I'm not just making this up to make it fit, folks. My students know this, and I'm giving it to you for free. And even with that little nugget, if you go back and look at your trades you lost money on, that's going to be a huge revelation. You're like, oh, if I just would have, exactly. That's what it's like when you have a real mentor, folks. Okay, so anyway, we have a down close candle, split it in half. From that range right here, I'm rough eyeballing it, okay, from this level here down to the low. So the next candle, if it opens, it can trade up, not to the 50% and higher. That's not an ideal scenario, but we want to see the sell scenario that would lead to lower prices form between the midpoint of the candle to the low. Okay, so in other words, what's happening is the algorithm knows the previous day's range, and it divides it in half, and that low on this candle to that midpoint of that candle, that's the operating range that the macro will work within. And what do I mean by that? The delivery will start on this candle's open and trade up into the range of half to the low of the previous candle. Okay, so that's where your setup's going to be. Right away, you have a huge advantage right there. When we drop down to the lower time frames, I'm going to go right into a 15-minute time frame, and you'll see that this candle's low is the lower of the blue line, and then this candle here, right here, that will be in a bearish order block that everybody's familiar with. Okay, so let's do that. Let's drop down. Remember all these levels here, and this little green line here, that's the 80 level, 91.80, as you can see right there. So let's drop down to a 15-minute time frame. All right, so here's the 15-minute time frame. We're focusing on the 31st of August, and the 5-minute fractal that I was showing is all of this. Okay, all of this right here is a market maker sell model. So from here to here, down to here, that is a 5-minute ICT market maker sell model. It's not Wyckoff, it's not harmonic, it's not Dow, it's not anything. Okay, it's exactly how I teach it. I'm going to give you some of the signatures here and shows you the contrast of why it's so perfect compared to everything else. So now we had price trading on the 31st. It starts right away higher, and it trades up into that first lower level, low, which is over here. Remember, I told you the lower of the blue lines. Rewind the video for a couple seconds and you'll see what I'm referring to before we transition to the 15-minute chart, if you lost track of what this level is. That's that previous low, and in that higher blue line, I told you that would be a 15-minute bearish order block. Relative equal highs, so it's trading back up into that low here, and then stretching beyond because it has to get above these levels here to take out that liquidity. What liquidity rests above that? Buy side liquidity. What does that mean? Buy stops. Anyone that's going short, that's trailed their stop loss, they feel comfortable with placing their buy stop here. As prices broke down, they think that this is where the logical level would be to put their protective stop loss. And when you know it, that's exactly where the market goes. And if you've been trading with live funds, you know exactly what that feels like. I'm teaching you how to avoid that, and more specifically, how to use it to frame your entries and manage your stops. Last up close candle in this price swing, that opening price, okay, you're going to look at this figure right here. The opening price on that candle is 92.48. Okay, 92.48. Price trades right up into that. What's the high of this candle? You're looking at it right here, okay? 92.48. Now, let me ask you something. Is that close? Is that within an earshot? Again, I know I'm being facetious. It's perfect, folks. It's absolutely to the pip. You cannot get any better than that. It's absolutely impossible for you to improve upon this. Zero potential to improve upon. It trades up to that level and then starts to break down. That candle is your smart money reversal. Now you have to look for your low risk sell. Where does that occur? Well, as you see price going up, this is the curve. Okay, and I taught this in the last video where I was differentiating my concepts versus that of Wyckoff. If Wyckoff was alive, Wyckoff would be my student. And I know that probably killed a lot of you right now, and you probably just want to turn the video off, but that's the truth, folks, okay? Because what I'm sharing here isn't found anywhere else. And they copy me by saying those things, oh, this is taught nowhere else, but it's my stuff. But if you look at the precision that I'm showing you here, it's undeniable, absolutely undeniable. But every movement of price where it's down, in other words, the down close candles prior to the smart money reversal, where the curve changes from buy side to sell side, all the down close candles match that up with a move on the right side of the highest candle here. In other words, at the smart money reversal of the market maker sell model. If you're new, this is your first time watching this video, as never been a student of mine or never watched any other videos in my YouTube library, this part's going right over your head. But I promise you, if you go through the other series in this YouTube channel, you'll know what I'm talking about when I say market maker buy model and sell models. But to the right of this candle, everything that's a short has to match up with what was a down close candle on this side. Okay, that's not Wyckoff. It matches perfectly. This was one of the reasons that I just said there's no way that everyone sees the same thing and lines up with support resistance, harmonic, Elliott wave, all these ideas, okay, that were supposedly explaining away how price moves. It didn't jive. It was nonsense. It's absolute nonsense. So when you look at the level of precision that's coming, and I'm not done, but when we anticipate lower prices, I am looking for the market maker sell model. Okay, that's the thing I'm looking for in my setups. So if I'm bearish, I'm looking for this pattern. Okay, wherever the original consolidation is, I'm selling with that in mind, and then I'll leave something on to capture any runners that would hopefully develop. So if you're looking for this pattern or fractal to form in a bearish environment, you have a real likelihood to catch a runner because you're just getting in sync with the move, which is the algorithmic repricing to this fair value gap. That's what this level is here and here. These big thick red lines, I made them that way so that way when we drop down the lower time frame, that's that range I said it would reach down into. And it went below the 92 figure, and here's the 80 level. Okay, 91.80. Look at the respect it's having in that level, and then it repriced higher. But more specifically, I gave you a fractal and I asked you, what do you see? Some of you may have seen, especially most of my students that have been with me for a while and has been trained, they see the market maker sell model on that 5-minute chart. This is 15 still. I'll drop down to the 5-minute in a moment. But at the time, we have this area right here. Okay, all this displacement on the downside, it trades down to the top end of that old fair value gap that I showed you on the daily chart that the market was going to reach down to since June 10th. Look at this down close candle right there. What's the low of that candle? 92.30. Okay. What's the high of this candle? 92.30. Now, is there any room for improvement? Zero. It's absolutely perfect. Now, you cannot find this in any other school of thought. Okay, if you're dealing with supply and demand zones, you're dealing with a range and you got to guess where you're working to enter. I don't guess. My students know we have a theology that is specific, it's precise, it's unambiguous, it's to the pip. This is what I'm referring to. When I teach these concepts, okay, there's going to be periods where there's uncertainty. When it's like that, I am 100% honest and I say, look, right now, it can go either way. But I have to still co-sign and say, this is where I think it's going. Because I'm obligated. I have to give them what my interpretation of price is. But in that same level of disclosure, I'm also saying, but I'm not participating in any trades right now. But this is what I think is going to happen. So in honesty, these are the things that I've taught my students, but they all know that I was not active in trading in the last week. Okay, so just know that this is how you learn, though. You learn this by studying a concept that is obviously has to be in hindsight, because you can't teach someone something they've never seen before without seeing the footprint of it. And that's what we're showing here. It's like a fingerprint of what the algorithm does all the time, every single day of the week. But you have to understand what it's doing and why is it doing it. So we have this area that was a buying point prior to it makes this high. When it starts to break down, any buying point has to be mitigated. So this becomes a mitigation block. Ooh, the plot thickens. All right, so now let's drop into a 5-minute chart and bring this video to a close. All right, so here's the 5-minute chart. And you can see very specific levels here. This down close candle prior to this run up, extend that out in time, hits it 2 times and then breaks lower. Here's that down close candle here. It hits it, trades down. It's attacking the original consolidation over here. But that's not all there is to the move. You have to submit to what it's likely to reach down to, which was, this was the top of that fair value gap, but it can drop lower. So if we get another selling opportunity, what would that look like? Well, we have buy side liquidity resting above these highs and bearish order block that's inside. In other words, this last up close candle overlaps with this mitigation block, and then you get this. Isn't that an optimal trade entry? Sure it is. This is what I teach on this YouTube channel. Here's your 70.5. That's your sweet spot. Bam. Hello. Thank you, ma'am. And then starts to break lower. It reaches down into the 92 big figure, bounces, and creates another rebalance to this level right in here. What is this level? That 92.22 level. It's that fair value gap level. Okay? There is an educator that I've always pointed to in the realm of Forex, and I'll do it again here. His name's Chris Laurie. Everyone that has ever looked at any of his stuff, they will know right away if you say the words liquidity void. Okay? Liquidity void is basically a price vacuum. Okay? That term preceded both of us, and we're not young men. Okay? That idea I've never claimed ownership of. The fair value gap is there's a specific element there. An imbalance is mine. It's not anything from Chris Laurie, none of that stuff. What I'm going to say now, I'm saying with a great deal of respect. Chris Laurie teaches how to use liquidity voids. Okay? Can you make money with it? Yes. Is it valuable? Yes. But it's limited. Okay? Once they fill, he's done. I'm not done. With a fair value gap, they can be recapitalized. So here's that same level. Now, convince me, please, that this level would have been any other support and resistance level. Okay? You're going to look at this level back here and say, oh yeah, it's this level here, and it went right back to that level there. Okay, well, why that one and not that one, or this one, or this one? You see, again, you have a goalpost that's constantly moving. My concepts are static. It has to be, otherwise the algorithm is going to never understand what it should do next. So it's repricing back to that old fair value gap, because that's the nature of where it was trading to anyway. That was the target. So it's going to work within that range. What range? That's the high end of it. That's the low end of it. Okay. So price breaks into it. It goes to the midpoint of that. I teach that as consequent encroachment. Michael, you're giving away all the mentorship. No, I'm proving authorship. I own this. Again, this is not teaching you how to go in there tomorrow and start using it, but I'm proving that this is what the algorithm does. It's not guesswork. It's not just selling capitulation and buying capitulation, selling pressure, buying pressure, supply and demand. None of that stuff. It's absolutely controlled. So it trades back to the top of the fair value gap again and into the imbalance that's created here, but doesn't completely close it in. What happens in price? Hits the top of that fair value gap and then trades down here. Folks, this is real support and resistance. That's how, when I look at price, I'm looking for some of the things that I've shown here. Many more things than I'm showing you now, but this is the type of stuff I'm looking for. And this is where the markets react. You want to know where the market setups are going to occur? It's this kind of stuff, not all the other things that have a very low strike rate. Again, what is happening in price? Is it following the logic of supply and demand? Is it following the logic of Elliott wave and harmonic patterns? Or is it something else that it's always doing that you've never really been exposed to? And that's been my whole life's work. When I finally decided I was going to start teaching in 1996, I sat down and said, I'm going to make my life a journey of convincing everyone that these books and these courses and these educators are regurgitating things that are not linked to how price is booked. Period. End of story. And I have a long history of proving it before it happens. And I could sit down, and again, you're going to hear this a lot, and it's going to make you sick, and too bad, swallow it. I can do this in a court of law and tell what's going to happen before it happens, period. I don't need to do this with a live account. I prove it every single week that this is what's likely to occur. And I've been doing it for years now in the presence of thousands. Okay. So if it isn't true, then what is it? Why is it happening? Why is it reacting like this? Because these things aren't found in any other school of thought. Think. I have been telling you the truth all this time. All this time. And many of you have choked on the fact that I was using demo accounts for my own protection, that it couldn't be real. It can't be real. It can't be. And yet it is. Market trades down to the bottom of that fair value gap and then plunges through it. Why? Because there's a lot of liquidity that was being built up below that fair value gap and into that liquidity void that was shown on the daily chart way back in the past. Reaches into the 80 level, works the 80 level multiple times, reprices back above and through, and here where we're at now. So, what do you do with this information? Sounds like a whole lot of nonsense, right? A lot of you cynical people. I want you to go through the videos on my YouTube channel and you can see the examples where I'm actually trading with a 1-minute chart. I'm using a lot of these ideas and a lot of things that I'm never going to teach. Now, wait a minute. That's nasty. It's just ignorant. You're just being just spiteful now, Michael. No, there's certain things I'm not allowed to teach you. I'm not allowed. Okay, so but what I'm showing you here, there's a lot of overlap with what I was doing in that 1-minute chart and showing the buying and selling in the same day. Buying and selling, reversing, and getting all these turning points. When you sit down with me and you see and study me giving you these types of ideas before they happen. Now, for disclosure, I did not sit down and outline all of this 5-minute fractal with my mentorship group. Okay, so I want to be very clear. I did not do that. I did tell them that it was going to trade down to these levels in here and work that fair value gap and maybe sweep into the 91s. We got it. The details are inside of the lessons, and then you go in and practice it. Even in this YouTube channel, everyone that studied my core content in this free library understands that this is all Judas swing. You all understand that. But you won't anticipate this price run and look to sell short at this bearish order block on a 15-minute time frame and expect the high of the day to form unless you understand the context that we still have unfinished business down in this fair value gap on a longer term basis. So you have to have an understanding and how the time frame's glad hand. And what is that? Working from a higher time frame down to a lower time frame, top down, that's an understood concept. But I have looked at every school of thought, and anytime they've talked about top down approach, okay, where you're using higher time frames down to the lower time frame, it still was lacking. It didn't fill in all of the huge chasms in logic that would constitute a system that is repeating over and over. Think about it, okay? I'm going to challenge you with this thought and close the video. If every single one of these ideas and schools of thought for trading, if all of them were really the thing that makes the markets move around, why is it that everyone that gets into trading jumps from each one of them over the course of the development? Think about it. Because if any one of those were the thing that causes price to move around, what creates the signal, what creates the gyrations and the draw on liquidity to where it draws to a specific target, if any of those things were true, no one would system hop. They would just stick right where they've been planted. You know what's funny about my content? Once you find yourself here, everything else looks like garbage. It's once you have been exposed to this, everything else is absolute nonsense. It's stupid to do anything else. Then you take your time and you pursue this, because this is actually how the markets book, because it's algorithmic. You don't have any control over the algorithm. It's going to do what it's going to do. And it does not matter. It does not care or respect your theology. It doesn't care about your indicators. It doesn't care about who your guru educator was. It doesn't care how many times it's been right in the past using your school of thought. When it fails, I can take you into the chart and show you how IPTA was doing what it was doing. I know when I'm likely to be wrong. I know when that's going to be likely to occur. So I scale back my trading or completely sit on my hands. You don't get those clear indications in other schools of thoughts. It's push your edge. As long as you have an edge, you push it, you push it, you push it. Well, that's dulling an edge. I know when my edge is likely to cleave off to the sweetest of the meat, which is closest to the bone. When it's not likely to offer that meat, I'm sharpening my edge. I'm not worrying about missing something, because the things I teach repeat every single day. Every day, because it is the market. Now, this stuff works in futures. It works in index. It works in even the commodities markets like soybean market. In fact, I'm going to challenge you to go back and look at the 20 trading executions or examples, I think it was, that I gave for the optimal trade entry pattern recognition series. I don't recall off the top of my head which one it was that shows the example for soybeans, but you can look at soybeans daily chart for the November contract, and it has performed like gangbusters. And it has a lot of the things I'm talking about here, just in an opposite terms, where we're looking for lower prices to justify shorting dollar. Not that I trade dollar, I use it as a barometer. So if I'm expecting lower prices in dollar, what am I really saying about euro? It should go higher. What am I saying for cable? That GBP USD should go higher. All right. So I gave you a lot of things here, and maybe I probably turned you off entirely to me. Okay. And if that's the case, I sincerely wish you good luck, good trading, whatever discipline you use, whoever you use as an educator. I wish you luck. I really, really sincerely wish you luck. If I have whet your appetite, I promise you, as we work towards the end of the year, I'm going to tease you a lot with things that you won't find in textbooks, in courses, okay? But I want you, if you're considering joining in my only enrollment for mentorship in 2021, it's in January, I will invite every single one of you on this YouTube channel. I will create a video that will outline everything that you have to do to get into it. No one can enter it before. I'm getting slammed with emails, so many so that I have to create another email address so that way my mentorship students can reach me, because it's just gotten ridiculous. So many people are emailing me wanting to join. I want you to understand that you all will have the opportunity to join, but none of you are going in before anyone else. Okay? The invitation will be extended formally the week of Christmas. Okay, so what does that look like? We are here today, and you will be notified on YouTube with a video the 21st of December. Okay, so I'll post a video. It'll give you an overview about what it is you're getting involved in, what your expectations should be, so that way you have a very clear depiction of what it is that you're joining. I'll give you very specific details on how you go about joining, the costs. The cost, I'll just tell you right now, because this will turn off all of you that are not willing to pay. It's 12 payments of $155 US dollars, payable by PayPal only. I don't take Bitcoin. I don't take any other form of payment. Okay. If you can't create a PayPal account in your name that's matching your mailing address, then you won't be able to join. I don't make any exceptions for anyone. Okay. It is $155, 12 times, so it's paid on a monthly basis. The payments are due at the first of the month, but I give a grace period up to the 9th of each month. On the 10th, when we wake up, where I live, if the payment has been made, then we'll process it. But if it's not been made, we remove your access. You will have until the first of the next month to restore your account. If it doesn't happen, you're removed from the mentorship entirely. You can pay early on the 27th of the month. So our pay period or billing cycle is the 27th to the 9th. So it's a rolling period of days that every single month starts the same way, the 27th to the 9th. So you have 9 days into the new month of access. And if you haven't paid by then, on the 10th, we remove your access. Now, it's 12 payments at $155, but then you have one final payment of $150, and that's your charter member payment. And once you pay that, you absolutely never, ever, 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 ever pay me a penny more, ever, unless you lose your password or if you need to make a change to your account. We always ask you to send PayPal $1 because it has to be the same PayPal account you sent us payments through, and all that is to verify that that's your identity and that you're the person. And we've had lots of people, and believe me, they all have been expected to do that. But you're not paying me anymore. I'm not going to constantly milk you forever. I'm offering you a seat in this private community. So everything I'm ever going to teach will be in this community. Now, I'm going to make YouTube videos. So if you can't afford this, don't think that you're never going to get anything from me ever again. I love doing this, but I'm going to stay only so far in YouTube. And then I'm not going to go into mentorship because I have to respect the investment that my students have made and also preserve the value, because this is my life. Okay. I've been doing this for 27 years. Nothing else is like it. And I have so much more to teach. And I can also tweak the things I've already given you for free. So if you just can't afford it, okay, I understand. I do not give scholarships. I get a lot of emails for that. Can you? I'm poor from Africa. I'm poor in Russia. You know, I don't do that, because for me to do that, this basically disrespects everyone else that's paid. You have to do that. Okay. Now you can be mad at me and say, "Oh, you're a sellout. You're a jerk. You know, you're a demon." Like some chat rooms are calling me now. I'm a demon. Listen, folks. There's certain things that are just simply not for the public. They're not. And I have lived a long life with this information, and I preserved it. And now I'm getting older, and I've wanted to do more, than I have in my younger years in terms of, providing content that's usable and it's transcends everything else. Where I'm taking everyone, you have no idea. I do, but you have no idea the journey that's in front of you. And it's still a wonderful journey if you can't afford mentorship. This YouTube channel, it's not getting taken down. I'm not going to remove the videos. Study them. And I'm 100% confident that if you give it enough time, you will find a way to make that into a profitable system, method, trading plan, trade model, whatever you want to call it. You'll be able to sit down and decipher price action in a certain way that fits your personality. That happens if you give it enough time. But if you come here and you're expecting me to hand you a signal and say, okay, buy here, sell here, that's not what I do. I don't do that. Because if you do that with someone, I could have you all addicted to that trade crack. Okay? And if I did a workshop, say for 1 week, and I sat on YouTube and I did live streams, and I literally gave you what was going to happen before it happened, you know what you would do? You would grow in excitement about that and never really spend time learning how to do it. What value is that? At any time, if I want to stop doing that, then you're stuck. I didn't want signals. I wanted to be able to do this on my own and be independent in the process. Where if, for instance, Larry Williams, because I bought his 900 line hotline stuff and I was paying his exorbitant rates to get trades that didn't work out for me. Okay. I know that giving someone the skill set, once you have it, it's yours. Your boss can't take it from you. Your spouse can't take it from you. Nothing. As long as you have the faculties, the mental faculties and such, and the finances to work with it, you can make it whatever you want it to be. And that's empowerment. Whereas if I run a signal service like I did in the 90s, I did a signal service with the S&P at 1,000 subscribers. And I did pretty good. But everybody was just hooked on the next trade. And none of them were interested in learning. I even tried to do workshops back then. Hey, you want to learn? Nah, I just want to stick to the signals. I don't have time for it. What? It made no sense to me. Because I was tired of doing the signals. So, this whole YouTube channel, okay, it's really meant to inspire you to believe in yourself. Because if you use the things I'm teaching you here in this free library, I absolutely believe in you. Because I know what you're putting your hands on right now is the freaking best. It's the best. I'm sorry if you're an educator and that hurts your feelings and makes you just cringe, but there ain't nothing like this. Nothing. That's why no one steps to me. That's why no one's been able to do the things that you see this YouTube channel do. They may talk about it in hindsight. They may talk about it, after it's happened, but they're never outlining it beforehand. And in mentorship, I am obligated to point to where it's going to go to next. Think about that. There has never been this expose of ICT doesn't know what he's doing and everybody is leaving the mentorship. That's not how it works. Everyone's flooding to get in, and I can't keep up with the demand. So what does that say? They're seeing something that you don't. I gave you an inside look today with a lot of the concepts, not all of them, but a lot of them that I don't even talk about on this YouTube channel. And should you think that you now have the imbalance or volume imbalance, let's go back out to a daily chart. I know, it just keep going on and on. But if you paid for this, wouldn't you want it to be long and full of rich content? See, that's the difference. If you don't pay for it, you just want everything real short and quick because your time's too valuable. Well, guess what? My time's more valuable. I'm going to spend it the way I want to. All right, so we're looking at the idea of a volume imbalance, okay? I outlined it over here, and it gave you that turning point here. I outlined it back here. It turned on. Now, again, when you join, for some of you that aren't going to join, then, whatever. this point doesn't mean anything to you. But the folks that have every aspiration to join, okay, I want you to think about these times in price and go back at these periods where we were doing the weekly commentaries, where I talked about price going up to here and then running this low and then running this low and then running down to here and then even this volume imbalance here. Go back. You'll see the videos. They're in the library. And once I make a video, if I make a mistake in a video, or if I omit something, or if I say something wrong, call a BISI a SIBI, or an imbalance, a volume imbalance, I've made a mistake and called it a fair value gap once in a while, because I'm not working with a script. Just like now, I'm speaking, and this is why sometimes I go overboard, because I don't have it spelled out with what I want to say. Because I don't have a boss except for my wife, and right now I have lots of time, so I can say what's on my mind and speak freely. If I make a mistake in a video, once it's uploaded, it's there. Right or wrong, glory or shame, okay, it is the way it is. Okay, I am absolutely 100% transparent. If I make a mistake, if I call it wrong, it is what it is. I eat it. But you'll see that these turning points that I've just mentioned here in just casual discussion, we spelled out before it happened. And that's what the mentorship is. I'm pointing to where the market's going on a higher time frame. So I'm keeping all my students framed on the right side of the marketplace. And then you use the tools I teach in the lessons and or the additional commentaries that's coming, and in whatever the price action models that I do for charter members and trading plans and such. And you use those as means to practice. Because I don't believe that everyone can train a specific way and they all agree to that methodology and they're profitable. Because we're all unique individuals. Some of you like certain sports. I hate sports. Some of you like certain weapons, and I like guns. I don't like certain guns. Okay, so we all have our own personal opinions about things, and the market is the same way. But it's more so in the realm of trading, because it's highly specific to our personality. If it doesn't jive with you or match your thought process about things or even life, you're probably not going to be successful with it. And that's the reason why a lot of people that come to me, if they don't subscribe to the evidence that I provide, then they're the ones that hate me, because they can't accept the facts that are shown to them. So therefore, I'm the jerk. I'm the liar, the fraud, the whatever. Okay? But I have evidence to prove all these things, and I have a track record behind it. Okay, I'm on record with it. So if I don't know what I'm talking about, I would have fallen on my face flat in 2016 when I started all this as a mentorship. Still keeps growing, and the streak continues. It's not 100%, but I'm in the high 90s. So if you look at this price action right there, okay, we have a close on that candle and the open there. That is basically the same thing I'm outlining here and over here, right? This little gap between the close and the open. Let me zoom in. Right here. So when price gets up to that level, it should sell off, right? Because that's a volume imbalance. That's what you all are going to do. The guys that are on YouTube trying to take my stuff and pretend it's this and that, getting your side hustles on, that's not a volume imbalance. There is no volume imbalance there. That's why it runs right on through it. There's logic behind over here that says that's not a volume imbalance. See, that's the difference of having someone that knows what they're talking about and a mentor. Well, like when I point out certain things in the charts, the price reacts at those. I'm not doing what you see me here doing, saying, okay, we're smart because look at this and look at that. I'm saying I'm accurate because I forecasted this turn and run down to here. I don't know how else to say it other than that. If you put your time in investing in the study of the things I give you on this YouTube channel, I guarantee, I promise, I absolutely believe that you will find your home in trading. Even if you can't afford or never even want to pay for a mentorship by me. You don't need to. I want you to know that. As much as it sounds like a sales pitch, I really want you to believe, and I I've worked my ass off since 2010 providing content that is absolutely game changing. And honestly, I had anxiety a few times with some of the lessons I've given out, because I just felt like I knew once I gave them that Yahoos out there would try to take it and rename it and never even credit me, because they want to try to make a fast buck off of it. And I'm sure later on in life they'll probably send me an email, say, hey, I'm one of that guys that did that. I was a jerk. I shouldn't have done it, but I regret doing it now, and I apologize, Bowler. I've had that in the past. Back the group from America Online, a lot of guys took my stuff back then and tried to repackage it, and I don't want to have relationships like that. I want all of the people that ever come into my life to say, hey, you know what? I'm thankful that you endured all the things you had to endure to get this. I'm thankful that the Lord blessed you with this, and you've kept your promise that you'd be willing to share it. I have done that. Okay? I have made this YouTube channel with that spirit in mind. I love teaching. I've prayed to be a teacher since I was a young man. I wanted to be a martial arts instructor. I've always wanted to teach. And obviously you can hear I'm very passionate about it. And there's nothing except for God that I'm more passionate about than trading, because I have done nothing more in life than this. This is, you heard it. If I could go back and talk to my younger self, I have literally sacrificed some of the most treasured moments in my life as a father and a husband to this. So the only satisfaction I can get is at least I'm really, really good at it. So I try to live there as a means of therapy. When I created this YouTube channel, it was twofold. Number one, it was a way for me to compensate myself emotionally and psychologically for all the things that I did to hurt myself in my own personal life. Physically, health. I created mental illnesses through this stuff, and I lost time with family members. I'm never going to get that back. So I'm not just a trading guru, educator, teacher. Okay, I'm a life coach. I don't want to be a life coach. I want to be a mentor that teaches you how to trade really well. But by default, I use my real life to show you, if you don't listen to what I'm teaching you, you're going to make these same painful mistakes. And they are much more costly than just using or blowing your account. You can always put more money back into an account, but you can't go back and spend those precious moments with your family again once they're gone. You can't do it. So if I can cultivate that mindset early on and steer you the right way and help you navigate, nothing could be more rewarding for me as an educator than that. Because if I can preserve you long enough for you to find yourself in this industry, I can't wait to read your story. I can't wait. I'm so excited to see what you did. Like, I can't wait. I am creating volumes of market wizards. You ever read that book from Jack Swagger? Two of those books, the first one and the second one, I think they're the best. The ones after that, I'm not really impressed with. No, I'm not trying to be disrespectful, Jack. But the point is, I love reading those stories. And I'm creating those types of people right now. And I'm so excited I hope I live long enough to see your story. I want to see it. And the small part that I had in that is going to bring me so much joy. And I'm so excited to see that. So with that, I'm going to wish you a very pleasant day. Wish you good luck, good trading, and I'll talk to you again on Thursday.